Chief Investment Strategist at SJ Markets. He joins us now live from Hong Kong. Darius, welcome to you. Great to see you again on the show.
Thank you.
Let me ask you about the stimulus package first up. Now, it's gone through the House of Reps. It still has to be passed through the Senate. I mean, what's your feeling on this? Are you fairly confident it will go through potentially as early as next week?
I think it is possible, although not sure. What is more important is whether there will be any modifications, and there is some chance that there will be improvement on the tax relief front in order to win at least some Republican votes, because Obama would like to have an at least somewhat bipartisan package passed through. But the key problem with the overall plan is that the fixed asset investments that were the initial rationale for putting up such a large investment are actually going to be delayed in terms of implementation, with most of them hitting the economy only next year and beyond, which means that this year the impact will be smaller than originally hoped for.
What about the talk of this plan that the administration is essentially talking about setting up a bad bank to buy up the toxic assets of other US banks? I mean, what is your view on this overall in terms of will it stimulate lending?
I think it's a necessary step, because otherwise you will not get the ability of investors to value the banks, and you will not get back confidence of private capital that is needed to recapitalize the banks. The problem with the bad bank model is that if you force banks in exchange to extend more loans to the economy that are risky in the current recessionary environment, then they will have new bad debts, and the market will not regain confidence in them. On the other hand, if you do not force them to extend loans, then they may be afraid to do it on their own accord because of the recessionary environment, and we will not see a stimulus for the economy from the bank bailout. So unless you have a very strong targeted fiscal stimulus plan that comes up very soon and is focused on fixed asset investments, the economy will remain in recession for longer than it would otherwise.
All right. Now, obviously, we have the Fed interacting in here as well. Now, we heard from some comments from the Fed last night, leaving interest rates close to zero. A lot of the analysts I've been speaking to say this should be at least until 2010, so interest rates aren't likely to move over the course of the next 10 months or so. When would you expect to see another move from the Fed in terms of moving interest rates?
This will happen only when the Fed is confident that we are seeing an economic recovery that is also inflationary, because right now they are concerned over too low levels of price movements. Because the Fed continues to roll out various programs that sort of increase its balance sheet and are in the quantitative easing arena, I think that they will not move interest rates higher until they roll them back, which I think will probably not happen until at the earliest Q4 this year.
All right. Okay, Darius, I will get you to stay with us just for the moment while we go to a quick break. Darius Kowalczyk, Chief Investment Strategist at SJ Markets, has been talking to us now. Now, coming up, we're going to continue our discussion now with Darius Kowalczyk. He's Chief Investment Strategist at SJ Markets. He joins us now live from our studios in Hong Kong. All right, Darius, now, just before the break, we were talking about this bad bank situation. I mean, what did you make of George Soros's comments?
I think he is really pessimistic, and I would imagine a little bit more than most people in the market and than myself. His negative comments on how TARP has been used so far, I think, as usual, are tainted by his political views, because he was very anti-Bush administration. I believe that what is needed even more than the larger amounts he is mentioning to recapitalize the banking system is to stimulate domestic demand, because even if banks are able to lend, they will not be willing to do so if they are afraid that continued contraction in domestic demand will produce even more bad loans. So the key issue is for the fiscal stimulus package to be constructed in such a way that demand is stimulated immediately. And I think that they have to focus more on fixed asset investments rather than on increasing unemployment benefits.
So in your view, is he overly bearish?
I think he is. I believe that as far as the U.S. economy goes, as well as China, fiscal stimulus measures will suffice to turn around their economies sometime in the second half of this year. I also believe that the contraction in consumption will not be as dramatic as he has suggested in some earlier clip. The rest of the world, unfortunately, has to wait for those two biggest economies, aside from Japan, to pull themselves out of recession and generate enough demand for exports from other countries to trigger an overall global recovery, which will probably happen in Q4 or in the first half of 2010 at the latest.
All right. Okay, Darius, let me ask you then about the greenback. We saw a little bit of a rally following the Fed's comments overnight. I mean, what's your view and how would you be trading the greenback right now?
I think that the U.S. currency is still a buy versus other majors and many other emerging units. The big selling point for the greenback right now is that it's the currency of the country whose policymakers are the most aggressive in dealing with the crisis, and therefore the U.S. will see the recovery first. This is making the U.S. unit, in my opinion, really attractive in the first half of this year. I expect it to go to 120 against the euro and move towards 100 against the yen in the first half of this year. It should also advance against emerging markets currencies, because recession in those markets will be deeper and longer lasting, and more trouble is here to come, including in our region in emerging Asia.
Darius, we have only about 30 seconds. GDP tomorrow, expectation around 5.4%. You're a little more bearish than that.
Exactly, we are going for a contraction of 6.5% because we are very pessimistic on how much fixed asset investments will contract, and also companies will run down their inventories at a breathtaking clip, which will actually be favorable for 2009 GDP, when those inventories will not have to be reduced anymore.
All right. Okay, Darius, great to have you on board the show today. Darius Kowalczyk with me there.
Thank you for having me.
Chief Investment Strategist at SJ.